Schwab is one of the biggest brokerages on the planet for a good reason. They have a variety of index funds that serve different purposes, which can help you put together a strong portfolio for building long-term wealth. And in this video, I'm covering 6 of the best Schwab index funds to help you choose the one that best fits your investing goals. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. The first on the list is SWTX, the Schwab Total Stock Market Index Fund. This fund tracks the Dow Jones US Total Stock Market Index, which is as broad as you can get. By that I mean it's giving exposure to essentially the entire US stock market. This includes all sizes of companies like large caps, mid caps, and small cap US companies. So it's really maximizing diversification within the US. And it's market cap weighted, so the larger companies are going to be making up a bigger portion of the fund. Since SWTX is a total market fund, it holds a large amount of stocks with a portfolio of 2,859 holdings. And the top holdings are in companies that I'm sure you're familiar with, like Nvidia, Apple, Microsoft, Amazon, Google, Meta, and others. For the sector exposure, technology is the largest, then financials, industrials, healthcare, and more. The nice spread of exposure to the different sectors and the amount of holdings that the fund has makes it well diversified since it reflects the entire US stock market. And if that isn't good enough, the expense ratio is super low at 0.03%, costing you $3 per year for every $10,000 invested. And Schwab tends to do a really good job here when it comes to the fees for their funds. I think it's fair to say that the overall performance of the US stock market has been great, and it's clear to see it in this fund as it's had returns of 16.8% in the past year, with 5-year annual returns of 12.2% and annual returns of about 15% over the past 10 years, which is very solid. The main draw of a total stock market fund is the wide range of stocks that it holds. You're not just getting the biggest and best companies in the market, but also a variety of mid and small cap companies that you wouldn't have in an S&P 500 fund, for example. You're diversified across the entire US stock market, so it not only opens the door for more opportunities, but also for potentially more balance. Also, something to be aware of is that since this is a market cap weighted fund, the largest companies are making up a huge chunk of the portfolio, while the exposure is pretty small in those smaller companies. This means the mid and small cap companies aren't really going to be making a noticeable difference on the performance. Now, if that matters to you, maybe having a fund that's focused on small and mid caps in your portfolio is something to think about. But this is by far the simplest way to be exposed to the whole US stock market through one single fund. And it's for those investors that want diversification and exposure to the US stock market with a low fee without caring about how much large, mid, or small cap exposure you have. The second fund we have is swppx, the Schwab S&P 500 Index Fund. Unlike the previous fund that holds the total US stock market, this fund tracks the S&P 500 index. And this fund holds the 500 largest companies in the US. And while this might not seem like a lot, these 500 companies make up around 80% of the total US market cap value. So it's still a great representation of the US stock market, and it's why the S&P 500 is often the benchmark that's used when referring to the US market. The portfolio of swppx contains 503 holdings, with top holdings in names like Nvidia, Apple, Microsoft, Amazon, Google, and more. The sector side includes technology, financials, communication, and a handful of others. The holdings and sector exposure are going to look very similar to what we saw in SWTX, since it also includes those S&P 500 companies which make up a majority of the market. And the most noticeable difference is that there's more percentage allocated to the stocks in the top holdings for this S&P 500 fund. Now the fees are dirt cheap for this fund, with an expense ratio of 0.02%, costing you $2 yearly per $10,000 invested. Getting to the performance, swppx over the past year is up 16.5%, while over the last 5 years, the annual returns are 13.3%, and it's had annual returns of 15.5% over the past decade. This is a little bit higher than the total market fund, as the big tech names were the main drivers of the market growth over these past few years. The strength in the S&P 500 comes from those top 500 companies in the US, and it's backed up by a strong historical track record that spans over many decades and through a wide variety of market conditions. This fund is a great example of a stable, core, foundational holding that you can hold with other funds to build a resilient and diversified portfolio. But something to consider is that while it holds 500 companies, it might not be as diversified as some investors may like. The exposure to technology or tech-related stocks makes up about half of the fund. So anything drastic that happens to the sector, more specifically the big tech stocks, then it will have a big impact on this fund. Now, this isn't a big deal if you have conviction over the long term in the US stock market. Since the holdings of the S&P 500 changes over time, what's in the index today might not exist 5, 10, or 15 years down the road. And if you're an investor that wants a low-fee, diversified fund with the top 500 US companies that comes with a great track record, then this is a fund to definitely consider. Coming in at number 3 is SNXFX, the Schwab 1000 Index Fund. This fund tracks the performance of the Schwab 1000 index, and this is Schwab's own proprietary index that invests in the 1,000 largest companies in the US. So it invests in both large and mid-cap companies, and it covers about 90% of the total US stock market, which puts it in between a S&P 500 and a total US stock market fund. So it's still a very diversified fund, and it's also market cap weighted like the other funds we covered. SNXFX currently has 990 holdings in its portfolio, with the big names that you've already seen like Nvidia, Apple, Microsoft, Google, and others. The sector exposure leans mostly into technology, then financials, industrials, and more. The weight in the top holdings and the sector exposure is pretty close to what we saw in the S&P 500 fund, and that's just because this is essentially an extension of that fund. The expense ratio of this fund is 0.05%, costing you just $5 for every $10,000 invested, which is barely higher than the others so far, and that difference is pretty negligible. The performance of this index fund is going to be close to the other broad funds, with the return of about 16% in the last year, 5-year annual returns of 12.5%, and annual returns of 15.1% when looking over the last 10 years. Surprisingly, this is the oldest Schwab fund on the list since it was created in 1991, but that doesn't make it any better or worse than the others. It offers great diversification, and it gives you more stocks than an S&P 500 fund, but it doesn't get into the small caps like a total stock market fund does. The biggest companies make up most of the fund, and this is why there's only some small differences in performance when you compare it to a broader fund. The downsides are the same with most of the broad funds, which is that if you want more exposure to the smaller companies, you'll have to add a fund to complement this one. Also, the fund leans a bit more into tech, which is something to consider if that bothers you. But this is just the way that things currently sit with the top companies in the US stock market, and if you're invested for the long term, it really doesn't matter. This Schwab fund is another great option for getting exposure to the US stock market. And if you're someone that wants a bit more diversification than what you find in an S&P 500 fund, then be sure to keep this one in mind. This next fund is a bit more focused, and that's swssx, the Schwab Small Cap Index Fund. This fund tracks the Russell 2000 Index, which is only focused on US small cap companies, so no large or mid cap stocks. The small caps are companies that have a market value of $250 million to $2 billion. And this Russell 2000 Index requires companies to have a market cap of at least $30 million, so it cuts out the lower end of the micro cap stocks. The portfolio of swssx holds a decent amount of stocks, as it currently sits at 1,975 holdings. The top holdings include Moog, Hut, Viasat, BrightSpring, and MaxLinear, which makes up less than 10% of the portfolio. The sector exposure mostly leans into healthcare, financials, industrials, and technology. The fund is market cap weighted, but you can see that the top holdings are spread out pretty evenly. Also, the fund is pretty diversified across a variety of sectors, which is nice to see. This is another low-fee fund with an expense ratio of 0.04%, costing you $4 yearly per 10K invested. Now, when it comes to the performance of small cap stocks, they're starting to make a comeback after being in a slump for a few years. In the last year, this fund is up just over 30%, highlighting the steam that small caps have been picking up recently, while the 5-year annual returns are 7%, and the annual returns over the past decade are 11.6%. What makes this fund stand out is that it's giving you that direct exposure to small cap stocks, where the larger funds are barely giving you exposure to these same stocks. And since small cap stocks are younger and smaller companies, they have more growth potential than larger cap stocks. But that potential does have a trade-off, and it's that small cap stocks come with more risk and volatility. They're more vulnerable to downturns, economic uncertainty, and financial instability, which can come with bigger price movements and volatility. So when the market is rough, these stocks are going to get hit harder than the bigger and more established companies. But a small cap fund can be a great way to boost diversification or growth potential of a portfolio. And if you're looking to get that added exposure to small cap stocks that you won't find in a broad market fund, swssx is one to check out. This next fund brings us back to large cap stocks, and that's the Schwab US Large Cap Growth Index Fund. This fund tracks the Russell 1000 Growth Index, which picks stocks with growth characteristics from the largest 1,000 companies. So it's focused on stocks that are quickly growing their earnings, revenue, and expanding their businesses. And these tend to be companies that are in emerging and innovative industries that not only come with more growth potential, but also more volatility. That brings me to the portfolio where swlgx has 371 holdings. And those top holdings include big names like Nvidia, Apple, Google, Microsoft, and Broadcom. The sector side, which isn't much of a surprise, is heavy into technology, then communications, industrials, and consumer discretionary. These are very familiar top holdings since these big growth funds are some of the largest companies in the world and is what's been driving the growth in the US market these past few years. These top holdings also make up much more weight in the portfolio than what you saw in the broader market funds. And since much of the growth has been coming from tech and tech-related companies, that's why the exposure is so high. For the fees, this fund has an expense ratio of 0.035%, costing you $3.50 for every 10K invested. Sliding to the performance, this growth fund is up just 7.6% in the last year, with 5-year annual returns of 13.6% and annual returns of 17.5% since it was created almost 9 years ago, which is higher long-term returns than the S&P 500 or total US stock market. The big advantage to this fund is the concentration on the stocks that are really driving the growth in the stock market today and potentially into the future. I'm sure technology will stay a big part of this fund due to the positive future outlook of the tech sector and how much development and innovation that we're seeing on a regular basis. And this added exposure can be a great way to increase the growth potential of your portfolio, especially if you have a longer time horizon. The reason I say that is because this growth potential does come with more volatility. And if you still have a good amount of time to invest, then you can ride out the rough times. But if you're looking for more stability or you're in the preservation stage, then this fund probably isn't a good choice for you. Now, if you want exposure to growth stocks and more potential growth opportunities for your portfolio, then this could be a fund for you. The sixth fund is completely different, and that's swissx, the Schwab International Index Fund. This one tracks the MSCI EAFE index, which invests in stocks in developed markets that are outside of the US. This index holds large and mid-cap stocks from developed markets in Europe, Australasia, and Far East. An international fund is going to give you exposure to companies that you won't find in any of the other index funds listed. It allows you to maximize diversification by being exposed to stocks all around the world. Now, the portfolio of swissx currently has 691 holdings, and the top holdings are made up of companies like ASML, HSBC, Roche, Novartis, Nestle, Shell, and others, with exposure to sectors like financials, industrials, technology, and healthcare. This fund is pretty well balanced since there aren't any stocks that make up a big percentage of the fund, and there's a nice mix in sector exposure. Also, the country exposure mostly falls into Japan, the UK, France, Switzerland, and a handful of other countries, which remember, it's only focused on the developed markets. The expense ratio is very low like the others, at 0.06%, costing you $6 yearly for every 10K invested. And since this is an international fund, there's many stocks that pay dividends in it, so it comes with a nice dividend yield of 3.2% that's paid out annually. International markets have been making a comeback over the last year or two, where swissx has a 1-year return of about 17.8%, along with 3-year annual returns of 16.5%, 5-year annual returns of 9%, and annual returns over the decade of 9.7%. These are still pretty good long-term returns, and you can see the growth has been picking up in more recent years. What this fund offers that no other fund on this list can offer is exposure to stocks outside of the US stock market. If a well-rounded and balanced portfolio is your goal, then expanding to international stocks could be a good option since you're not only being exposed to just one economy. International exposure can improve diversification, lower volatility, and add some support to your portfolio if domestic markets are taken a hit. Like any investment, international stocks also come with risks, like geopolitical issues, currency, regulations, and more that occur outside of the US. Also, this fund doesn't give you exposure to emerging markets, so you're technically not exposed to the entire international market. Emerging market stocks can come with more growth potential, but they're much more volatile. Another thing is that performance might not look as great as some of the other core US funds, but keep in mind it's not meant to replace them, but instead it's meant to be combined together. We never know when and how long international markets could outperform the US stock market, so having combined exposure gives you the best of both worlds. Either way, if diversification is what you're looking for, then this international fund is definitely one to consider adding to your portfolio. And if you also invest in ETFs, I talk about the best ETFs that Schwab has to offer in this video here, or if you want to see some other options, I go over the best fidelity ETFs in this video here. If you made it this far, I appreciate you watching. Don't forget to hit the like button and subscribe for more content, and I'll be seeing you on the next one.